What we really focus on here at MLG, a key strategy of ours is getting people diversified. For the first 25 years of the company's history, we did all individually syndicated deals. So that it may be familiar to a lot of you. How that works is you find one property you like, you go out and raise money from investors for that one apartment complex or that one industrial building. Like I said, we've got a good batting average. We've had a lot of success in these one-off deals. The trouble with that strategy is you're not getting diversified. Inherently, you're taking on single asset risk. It's like being a stock picker instead of buying a mutual fund. And you might have a great batting average, but every once in a while, there are deals that don't go exactly as planned. There are unforeseen things that come up in the market. And diversification, spreading out risk across a basket of assets, is a way that we really focus on mitigating risk for our investors. We pivoted to this strategy in 2012, really as a response to what happened in the market in 2008, 2009. And it's been a really popular and well-received strategy by the marketplace ever since then. We're targeting diversification in two primary ways. The first is across different asset classes. You can see here we invest in multifamily, industrial, retail, and office. Multifamily is far and away our most preferred asset class. Typically, what we, more recent years, probably been closer to 90% of the investments we make are in multifamily. We'll even see some diversification within multifamily. We invest in a variety of asset classes, look at some value add class B apartments in good locations, all the way up to new construction class A type product, never building it ground up, at least so far in our funds. But we'll buy stuff that's just recently built and get some investors diversified across different multifamily asset classes. Industrial, we really like. Unfortunately, so does everyone else. And so it makes it hard to buy in bulk. But we still find ways to find smaller deals that still get some diversification mixed into the fund. I said multifamily is typically in the 90% range of what we do. Industrial, and we'll call it flex, where there's a component of industrial and a little bit of office in there, make up the bulk of the remainder. But we look at retail and office too. We view those two asset classes very, very opportunistically. Really, we view them as high CapEx businesses. And so unless there's a problem in a good location that we can fix and sell, we're not really buyers of retail and office. We don't want to be there when tenants leave. We want to be the ones putting them in a building and then getting out. So you'll find our strategy in retail and office tends to be more as a merchant buyer, where you're buying at a very low basis in a good location and then out in 2 to 3 years. Multifamily and industrial, we'd be more open to holding in the 7 to 10 year range. Or, if certain deals, if it makes sense to get out in 3 to 5 years, we're open to that too.
The hosts of the YQA Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.